Okay, in this video we're just going to discuss some of the major factors that influence demand and supply of the Australian dollar. Some of the ones you're more likely to be tested on and you need to articulate really carefully. First of all, just in relation to why the demand curve for the Australian dollar slopes downwards, that's because the lower the value of the Australian dollar, the higher the demand for our exports will be, and the more the foreign people will want to convert their currency into ours. So if the Australian dollar is low, not only does it increase the demand for exports, but it increases the demand for foreigners buying Australian property, investing in Australia, because they're getting more purchasing power for their currency. So they're more willing to demand our dollar at that point. When the higher the value of the Australian dollar, it means there's more incentive to supply the Australian dollar. So more Australian dollars will be supplied at a higher price, so up here, because we're going to get more purchasing power for our dollar. We're going to be able to afford more imports or afford more goods and services from overseas, or we might get more value if we want to invest in property overseas, and that's always an incentive for us to supply the Australian dollar. So what we're going to talk about in this video is some things that cause the changes in the demand and supply for the Australian dollar. So the first one, really important one, lower oil prices. Unlike lower coal prices or lower iron ore prices, lower oil prices, because we're a net importer of oil, if oil prices are lower, it means we have to exchange less of our currency to buy oil. So it should lead to a reduced supply of the Australian dollar. It's because less Australian dollars need to be converted into the foreign currency to purchase oil. And it's important to recognise that the demand for oil is relatively inelastic. So we're not going to demand a lot more oil, but because it's cheaper, we're not going to have to convert as much of our currency into theirs. So that will lead to basically a decrease in supply, so this way in supply, and should lead to a higher Australian dollar or an appreciation of the dollar because of the decrease in supply. Relative interest rates. Relative interest rates compares interest rates in Australia to what they are in other countries. So the bigger the gap between Australia's interest rates and foreign interest rates will have an impact on the value of the Australian dollar. So if the interest rate differential compares interest rates in Australia compared to overseas. So if there's high interest rates in Australia, that creates an incentive for foreigners to lend to Australia or to invest in Australia's banks. So when interest rates in Australia are really high, they'll be getting a high rate of return. So they want to lend us money because they know they're going to get a good rate to lend us money. They're also more likely to put money in Australian banks because they're going to generate higher return on any savings. And that all leads to what we call increased capital inflow. So higher interest rates lead to more capital inflow and therefore lead to more demand for the Australian dollar. Overseas citizens will deposit money in Australian banks or purchase bonds because they're going to get a higher yield here than they might get in their own country. This leads to increased capital inflow, boosting demand for the Australian dollar. If interest rates are low, Australian investors are more likely to invest overseas. So they will place their money overseas, or they might decide that they're going to buy shares or property overseas because they're going to get a better return than having money in Australian banks. All of this leads to more supply of the Australian dollar and leads to a depreciation of the Australian dollar. So capital inflows, it's not just putting money in foreign banks, it also includes direct and portfolio investment. So when foreigners expect greater returns on their investment, they will increase in their investment in Australia, that will appreciate the dollar as well. If foreigners expect the price of BHP and Rio Tinto to increase, they're more likely to put their shares into Australia, and that again will increase the demand for the Australian dollar. So countries, they believe that our companies are likely to do really well, then they're more likely to invest in Australia, and therefore the price should go up. As a country with a higher credit rating, other countries often look to invest in Australia. They think it's a safe investment, they think they're going to get a return on their money, and that's one of the things that keeps the Australian dollar high. If we suddenly lose our credit rating, then other countries might think they no longer want to invest in Australia because we become a credit risk. It may not be a good investment, and that will lead to a depreciation of the Australian dollar because there'll be less demand for the Australian dollar, or more supply if they take their investments out. Terms of trade, we talked about this in class. When the terms of trade increases, the price of Australia's exports have increased relative to imports. Commodity price exporters will be receiving more income, and that's going to increase the demand for the Australian dollar. More money needs to be exchanged into Australian currency if they want to purchase our products, and therefore that will lead to more credits and a higher demand for the Australian dollar. Relative rates of inflation. High rates of inflation reduce our international competitiveness. That's going to hurt our tradable sector. It may lead to reduced demand for exports and increased demand for imports. So a high rate of inflation is likely to reduce net export demand. It's likely to lead to less demand for the Australian dollar as we export less and potentially more supply, which will both lead to a depreciation of the Australian dollar. Overseas rates of growth. Higher growth overseas is likely to lead to an increased demand for inputs, so in our case, our exports for commodities and raw materials. That will lead to increased demand for the Australian dollar and an appreciation. Stronger overseas growth rates often lead to increased incomes as well. That's likely to boost the demand for tourism, boost the demand for education, and other what we call non-commodity related goods. So increased wealth, increased growth overseas is likely to lead to more demand and appreciation of the Australian dollar. Growth in national spending, so if Australians have got more money, if the growth is caused by strong export volumes, then it will appreciate the dollar. However, if it's caused by just general things that cause increased incomes, that will lead to a bigger gap between expenditure and production and could lead to increased demand for imports, which will increase supply of the dollar. So increased national spending, lower unemployment, higher disposable incomes, they all generally lead to more supply of the Australian dollar. We have more money to convert into foreign currencies. Okay, this is probably the hardest part of this video. You need to be aware of some microeconomic demand and supply side factors. So go back to the start of the year, think of your demand and supply side factors in microeconomics and how they can link to the Australian dollar. Just be mindful that some of these are demand side factors in that they impact the demand for goods and services, but they're actually impacting the supply of the Australian dollar. So for example, changes in disposable income would be one. If consumers in Australia have more disposable income, that can lead to a depreciation of the dollar because we have more purchasing power to buy imports. If the price of foreign substitutes increases, then we will supply less of the Australian dollar because we buy the Australian product instead. If foreign substitutes are cheaper, then we're more likely to buy the foreign substitute, so there'll be more supply. Increases in population in Australia will increase supply of the Australian dollar. If there's increased population or more consumer confidence overseas, that will increase demand for the Australian dollar. Changes in overseas preferences, so if more people overseas want to holiday in Australia, that's going to increase demand for the Australian dollar. Supply side factors, improvements in technology or productivity in Australia should help to lower our prices and lead to increased demand for the Australian dollar. Improved climatic conditions will increase demand for our exports. And then on the flip side, if we're becoming less productive or we have natural disasters, that will generally lead to less demand for the Australian dollar. So just be mindful that these supply side factors can still affect demand for the dollar, but they're supply side factors. Thank you.